Picture this, 2006. The economy is booming. The year is 2006. The US economy is humming along, fueled by a seemingly unstoppable housing market. People are buying homes at an unprecedented rate, and prices are skyrocketing. What could possibly go wrong? This is the story of the 2008 housing market crash, a financial earthquake that shook the world. It's a story of greed, recklessness, and the failure of those entrusted to protect us. Our journey begins with a simple question: how did we get here? To understand the crash, we need to rewind to the years leading up to it. A time when the American dream of home ownership morphed into a feeding frenzy, fueled by easy credit and Wall Street's insatiable appetite for profit. Owning a home, it's the American dream, right? For generations, owning a home has been the cornerstone of the American dream. But somewhere along the way, this dream became distorted, morphing into an obsession fueled by easy credit. The housing market became a casino, with everyone betting on ever-rising prices. Banks loosened their lending standards. Enter the era of subprime lending, where loans were offered to borrowers with poor credit history. These subprime mortgages were seen as high risk, but banks packaged and sold them off to investors. It was a house of cards built on a foundation of debt, and it was about to come crashing down. But these loans, they weren't your grandma's loans. These were adjustable rate mortgages, also known as ARMs, designed to lure in unsuspecting borrowers. They came with low introductory rates, often called teaser rates, which made monthly payments seem deceptively affordable. But here's the catch. Those low rates, they were temporary, like a free trial that ends with you owing a fortune. After the initial period, the interest rates could skyrocket, often doubling or even tripling the monthly payments. Wall Street, never one to miss a money-making opportunity, saw a gold mine. They saw those risky subprime mortgages, bundled them into complex financial products, and sold them off as low-risk investments. It was like turning a casino full of risky bets into what they claimed were surefire investments. These mortgage-backed securities, or MBSs, were incredibly complex. So complex that even the people selling them didn't fully understand the risks involved. But hey, as long as the music was playing, everyone was happy to keep dancing. To further complicate matters, Wall Street introduced another layer of financial engineering collateralized debt obligations, or CDOs. These were essentially bundles of MBSs, further sliced and diced into different risk categories or tranches. The idea was that even if some of the underlying mortgages defaulted, the higher-rated tranches of CDOs would still be safe. This complex web of financial instruments created the illusion of safety, attracting investors from around the world. Pension funds, insurance companies, sovereign wealth funds, everyone wanted a piece of the seemingly booming US housing market. But little did they know they were buying into a house of cards built on a foundation of shaky loans. Remember those mortgage-backed securities? They were like the fuel that kept the housing bubble inflating. As long as investors were willing to buy them, banks were happy to keep making risky loans. It was a vicious cycle, with Wall Street and the lending industry feeding each other's greed. To keep the money flowing, Wall Street needed more mortgages to package into these securities. So they pressured lenders to loosen their standards even further, leading to a race to the bottom in terms of lending practices. Credit rating agencies, the watchdogs of the financial system, were supposed to assess the risk of these complex securities. But instead of barking warnings, they wagged their tails and handed out A-delay ratings, the highest possible to many of these MBS and CDOs, despite the underlying risks. These ratings were like gold, reassuring investors that these complex products were safe bets. The problem was these ratings were based on flawed models that didn't account for the possibility of a widespread housing market downturn. They assumed that housing prices would continue to rise indefinitely. What could possibly go wrong? But wait, it gets worse. The credit rating agencies were raking in huge fees from the very institutions whose products they were rating. Talk about a conflict of interest. It was like a restaurant paying its own health inspector. This cozy relationship between Wall Street and the rating agencies meant that the risks of these complex financial products were downplayed or ignored. Investors, lulled into a false sense of security, poured trillions of dollars into the US housing market, fueling the bubble to unsustainable levels. But it wasn't just Wall Street and the rating agencies that were complicit in this financial house of cards. Regulators, the ones tasked with overseeing the financial system and protecting investors, were asleep at the wheel. They failed to recognize the systemic risks building up in the housing market and didn't rein in the reckless lending practices. It was a perfect storm of greed, recklessness, and regulatory failure. And as we all know, when it rains, it pours. Home buyers, many of whom were first-time homeowners, were often unaware of the risks they were taking on. They were lured in by the promises of easy money and the allure of home ownership, often without fully understanding the terms of their mortgages. Some were even encouraged by mortgage brokers to inflate their income or assets to qualify for larger loans. This wasn't just a case of individual greed or naivete. The system was rigged against ordinary Americans. They were bombarded with advertisements for no money down mortgages and low introductory rates, making home ownership seem within reach for the first time. The American dream, once a symbol of hope and opportunity, had been twisted into a predatory lending scheme, and the consequences of this financial recklessness would soon be felt by millions of Americans. But there were warning signs like storm clouds gathering on the horizon. Economists and financial analysts cautioned about the unsustainable rise in housing prices and the risks posed by subprime lending, but their warnings were largely ignored or dismissed as the voices of doom and gloom. The Federal Reserve, tasked with maintaining the stability of the financial system, kept interest rates low, which further fueled the housing boom. While low rates made borrowing cheaper, they also contributed to the rise in housing prices and encouraged risk-taking. As the housing bubble continued to inflate, some policymakers argued that the market would self-correct and that any downturn would be mild. They believed that the US economy was strong enough to withstand a housing market correction, but they were wrong, dead wrong. And the consequences of their complacency would be devastating. Remember that house of cards, built on shaky loans and false promises? It started to crumble. In 2007, the delinquency rates on those subprime mortgages began to climb. People who couldn't afford their skyrocketing monthly payments started defaulting on their loans. Remember those complex mortgage-backed securities? Their value was directly tied to the performance of those underlying mortgages. As more and more borrowers defaulted, the value of these securities started to plummet. It was like a game of hot potato, but instead of a harmless spud, it was a financial time bomb. And nobody wanted to be left holding it when it exploded. Financial institutions heavily invested in these toxic assets began to teeter on the brink. Bear Stearns, a Wall Street giant, was the first major casualty, collapsing in March 2008. but it wouldn't be the last. As housing prices plummeted, millions of homeowners found themselves underwater. That means they owed more on their mortgages than their homes were worth. Many had taken out loans they couldn't afford, enticed by those teaser rates and the allure of easy money. Now they were trapped. Foreclosures skyrocketed across the country. Neighborhoods once vibrant, now dotted with empty, boarded-up houses. The American dream for many had become a nightmare. The consequences went far beyond the individual families losing their homes. As foreclosures mounted, it created a downward spiral in the housing market. The glut of homes for sale drove prices down even further, exacerbating the problem. It wasn't just homeowners feeling the pain. The construction industry, which had been booming during the housing bubble, came to a screeching halt. Jobs were lost, businesses shuttered, and the economy spiraled downward. Remember those Wall Street banks that were raking in billions? The ones who packaged and sold those toxic mortgage-backed securities? Well, their chickens were coming home to roost. As the value of those securities evaporated, so too did the bank's assets. Lehman Brothers, another Wall Street giant, couldn't weather the storm. In September 2008, it filed for bankruptcy, the largest in US history. The financial system teetered on the precipice. Panic gripped the markets. Credit, the lifeblood of the economy, dried up. Businesses couldn't get loans to operate, consumers couldn't get credit to make purchases. The economy ground to a halt. The government, faced with a financial meltdown, took unprecedented action. They bailed out some of the biggest banks using taxpayer money to prop up the very institutions that had caused the crisis in the first place. The US financial system was on the brink of collapse. Extraordinary measures were needed, or so they said. The government stepped in with a $700 billion Troubled Asset Relief Program, or TARP, using taxpayer money to bail out the banks deemed too big to fail. The idea? Stabilize the financial system and prevent a complete economic collapse. But it came at a cost. The bailout sparked outrage among many Americans who saw it as a handout to the very institutions that had recklessly gambled with their money. The bailout was a bitter pill to swallow, but was it the right medicine? Did it work? That's debatable, but one thing's for sure. It left a bad taste in the mouths of many Americans. While Wall Street got bailed out, Main Street felt the full force of the crash. Millions lost their jobs, homes, and life savings. The unemployment rate soared to over 10%, a level not seen since the Great Depression. It was a brutal time for many Americans. The recession, triggered by the housing market crash, lasted for 18 long months, from December 2007 to June 2009. It was the longest and deepest economic downturn since the Great Depression. The gap between the rich and the poor, already widening before the crash, grew even larger. Those at the top, many of whom had caused the crisis, seemed to recover quickly, while those in the middle and at the bottom struggled to regain their footing. The American dream, once a beacon of hope for many, seemed further out of reach than ever. The crash exposed the deep flaws in the financial system and the growing inequality that threatened the very fabric of American society. The US housing market crash wasn't just an American problem, it triggered a global financial crisis. Remember those mortgage-backed securities? They were sold to investors around the world. When the US housing market collapsed, it sent shockwaves through the global financial system. Banks in Europe and Asia, heavily invested in those toxic US assets, suffered massive losses. Countries like Iceland and Ireland, with economies heavily reliant on the financial sector, experienced economic meltdowns. The world was interconnected in ways few fully grasped. The US housing market crash exposed the vulnerabilities of a globalized financial system, where a crisis in one corner of the world could quickly spread like wildfire. It was a stark reminder that we live in an interconnected world, for better or for worse, and that the actions of a few, driven by greed and recklessness, can have devastating consequences for us all. The dust settled, leaving behind a landscape scarred by the crisis. Millions of Americans lost their homes, their jobs, their savings. The economy, once a well-oiled machine, sputtered and stalled. It was a time of uncertainty and fear. The government, having just bailed out the very institutions that caused the crisis, faced a daunting task: how to rebuild an economy on shaky ground, how to restore faith in a system that had failed so many. The American dream, once synonymous with home ownership and upward mobility, felt like a distant memory for many. The crash exposed the fragility of that dream and the deep inequalities that had been festering beneath the surface of the booming economy. But amid the wreckage, there were glimmers of hope. Communities came together to support those who had lost everything. People showed resilience and a determination to rebuild their lives. The housing market, once a symbol of both dreams and recklessness, had to find its footing again. It was a slow and painful process. Prices, which had plummeted during the crash, took years to recover in many parts of the country. The days of easy credit and lax lending standards were over. The crash forced a much-needed reality check. Home ownership, once seen as a surefire investment, was now understood to carry inherent risks. The days of using your house as an ATM were over. The government implemented new regulations aimed at preventing another crisis. Dodd-Frank, a sweeping financial reform bill, was signed into law in 2010, but its effectiveness and scope remain subjects of debate. The housing market, once a free-for-all, was now subject to greater scrutiny and regulation. But had we done enough to prevent another bubble, another crash? Only time would tell. The crash exposed the dangers of a lightly regulated financial sector. It showed how unchecked greed and risk-taking could have devastating consequences for the entire economy. The question was, could we prevent it from happening again? Dodd-Frank, the government's answer to the crisis, aimed to rein in Wall Street's excesses. It introduced new rules for banks, created the Consumer Financial Protection Bureau to protect borrowers, and attempted to bring transparency to the murky world of derivatives. But Wall Street, known for its army of lobbyists and its ability to find loopholes, fought back against some of the regulations. The debate over the effectiveness of Dodd-Frank and whether it went far enough continues to this day. Some argued that the reforms didn't go far enough, that the biggest banks were still too big to fail and posed a systemic risk to the economy. Others argued that excessive regulation stifled economic growth and made it harder for businesses to lend and invest. The crash didn't create inequality, but it sure threw gasoline on the fire. Those who were already struggling minorities, low-income families, those without a college degree, were hit hardest by the crisis. They were more likely to lose their jobs, their homes and their savings. Meanwhile, those at the very top, the Wall Street executives, the wealthy investors, seemed to recover much faster. Some even profited from the crisis. The gap between the haves and the have-nots widened, further eroding the fabric of American society. The crash exposed the myth of trickle-down economics, the idea that wealth at the top would eventually benefit everyone. Instead, it showed how a system rigged in favor of the wealthy could exacerbate inequality and lead to social and economic instability. The Occupy Wall Street movement, which emerged in 2011, captured the anger and frustration of many Americans who felt that the system was rigged against them. Their slogan, "We are the 99%, resonated with those who felt left behind by an economy that seemed to benefit only the wealthy few. Fast forward to today, and the ghosts of 2008 still linger. The global economy has recovered, but the scars of the crisis remain. We see them in the widening gap between rich and poor, in the political polarization fueled by economic anxiety, in the lingering distrust of institutions. The housing market, while not in a bubble, is still grappling with affordability issues in many parts of the country. Student loan debt has reached crisis levels, mirroring the mortgage crisis in some ways. And the financial industry, while subject to more regulation, still wields enormous power and influence. The 2008 crash was a wake-up call, a stark reminder that our economic system is not infallible, that unchecked greed and risk-taking can have devastating consequences. But have we heeded that warning? So, the big question. Have we learned our lesson from the 2008 crash? Have we taken the necessary steps to prevent another financial meltdown? Have we addressed the underlying issues of inequality and a financial system that seems to benefit the few at the expense of the many? The answer, unfortunately, is not a simple one. Some progress has been made. Dodd-Frank, for all its flaws, introduced some much-needed reforms. The financial industry is subject to greater scrutiny, and there is a greater awareness of the systemic risks posed by a highly interconnected global economy. But the forces that led to the crisis, greed, short-termism, a lack of accountability, are still present. The political will to address the root causes of inequality remains elusive, and the global economy, more interconnected than ever, is vulnerable to new and unforeseen shocks. The 2008 crash was a painful lesson, but it was a lesson nonetheless. The question is, will we learn from our mistakes and create a more just and sustainable economic system, or are we doomed to repeat the mistakes of the past? The answer, ultimately, is up to us. So here we are, years after the financial flood receded. We've cleaned up the mess, or at least we think we have. But have we really learned anything from the 2008 housing market crash? Or are we, as a society, doomed to repeat the mistakes of the past? It's human nature to want to move on, to forget about the bad times. But when it comes to something as consequential as the economy, forgetting is a luxury we can't afford. The scars of the 2008 crash run deep, and the lessons we learned or failed to learn will continue to shape our future. This isn't just about economics, it's about trust. Trust in our financial institutions, trust in our government, and trust in the very idea that hard work and responsible behaviour will be rewarded. That trust, shattered by the events of 2008, is much harder to rebuild than any skyscraper or bank balance. So let's take a hard look at what we've learned, what we've ignored, and what's at stake as we navigate the ever-changing landscape of the global economy. Because the truth is, the story of the 2008 housing market crash isn't over. It's still being written. After the crash, there were calls for heads to roll and rules to be rewritten, and to be fair, some changes were made. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, was a step in the right direction, introducing stricter regulations for banks and creating the Consumer Financial Protection Bureau. But let's be real, Wall Street is like a master of escape, always finding new ways to wriggle free from regulations. The battle between those who believe in a free market and those who believe in government oversight continues to rage. And guess what? The average American is caught in the middle. The question is, have we found the right balance? Or are we still one financial crisis away from another bailout? Because let's not forget, those bailouts, while they might have prevented a complete economic collapse, came at a cost borne by taxpayers, many of whom were struggling to stay afloat themselves. Remember that growing gap between the rich and everyone else? Yeah, that didn't magically disappear after the crash. In fact, it got worse. The top 1% of earners, those who often benefited the most from risky financial practices, recovered quickly. The rest, not so much. This isn't just about fairness, although that's certainly part of it. It's about the stability of our society. When so much wealth is concentrated in the hands of so few, it creates a system that's inherently unstable. It's like building a house on a foundation of sand. Sooner or later, it's going to crumble. So, what's the solution? Well, that's a question that economists and policymakers are still grappling with. But one thing's for sure, ignoring the problem won't make it go away. In fact, it's likely to make it worse. So, where does the American dream fit into all of this? Remember that whole idea of working hard, buying a home, and achieving upward mobility? Well, for many Americans, that dream feels more elusive than ever. The cost of housing has skyrocketed in many parts of the country, wages have stagnated, and the cost of education and healthcare continues to rise. It's no wonder that so many people are struggling to make ends meet, let alone get ahead. But here's the thing. The American dream shouldn't be a pipe dream. It shouldn't be a luxury reserved for the wealthy few. It should be attainable for everyone who's willing to work hard and play by the rules. The question is, are we willing to fight for it? Are we willing to demand policies that promote economic opportunity for all, not just those at the top? Because the future of our country, our democracy, and our very way of life may depend on it. The 2008 housing crisis wasn't just a blip on the radar, it was a seismic event that exposed the fault lines in our economic system. And guess what? Those fault lines are still there. We live in a world of increasing complexity and interconnectedness. Globalization, technological advancements, and climate change are just some of the factors that are reshaping our world at an unprecedented pace. In this rapidly changing landscape, the only certainty is uncertainty. We don't know when or where the next crisis will hit, but we can be sure that it will. The question is, will we be ready? But hey, maybe we're all just a bunch of optimists clinging to the hope that things will be different this time. Maybe we're wrong to think that we can learn from the past and create a better future. Maybe greed and short-sightedness are just hardwired into our DNA. But here's the thing, even if we're wrong, even if we're doomed to repeat the mistakes of the past, we have a moral obligation to try. We owe it to ourselves, to our children, and to future generations to create a more just, equitable, and sustainable world. The 2008 housing market crash was a tragedy, but it was also a wake-up call. It's up to us to decide what lessons we learn and what kind of future we build. The choice, as always, is ours.